Hey everyone, this is the first video in a series where I will be walking you through all of the homework 1 exercises for chapter 0. So let's get started. All right, so as I mentioned in our lecture video, chapter 0 is really all about reactivating that accounting knowledge in your mind and getting you back into this accounting mindset so that we can be all operating from a good place of knowledge and understanding of foundational accounting concepts as we move into the managerial accounting course. So with that said, exercise 1 has a listing of different types of accounts. Here you can see equipment, supplies, unearned revenue, common stock, so on and so forth. And you'll notice there's more down here as you scroll down, so be sure to follow along. And for each of these accounts, we need to identify what account type that account falls under. What is the normal balance of this type of account? Is it a debit or a credit? And what financial statement would we find this item on, whether balance sheet or income statement? And we don't have any items specifically that would be on like a statement of retained earnings or anything like that. We're just focusing on balance sheet or income statement with these items, just in case you had that question. Okay, so let's begin. The first one, as it mentions here, has been completed for you. We're talking about equipment here. And remember, equipment is an asset. It's something that you own, a business owns. It has ongoing utility going forward. And you're able to generate revenues and operate a business with this type of thing. So it's an asset. And you know what? I'm going to put one acronym here off to the side because I think this might be helpful for everyone and kind of a revisit of some foundational kind of little tips and tricks here. So you might remember from your accounting class this concept of dead circle, kind of a weird name, but hopefully this is familiar to you. Essentially, the idea here is that we have this little word tool, I believe a mnemonic device. Oops, I should have put this. So that's credit. You don't have to type this onto your version. I'm just doing this as a illustrative thing to help us as we work through. But if you want to, totally fine. But dead circle. So it's a way for us to remember to kind of easily remember whether in a certain account type is increased with a debit or a credit. And when we say which is increased, that's just another way of saying what is the normal balance of that account. So if it increases with a debit, that means that assets have a debit normal balance. So let me just fill this in real quick. Oops, spelled that wrong. Revenue. Remember what the C stands for. Contributions, capital, we'll say. Basically equity related items. Dividends, again, kind of equity item. We don't have any equity stuff here on this specific problem, but I just want to write this out for us in full, so it might help you in the future as you're trying to remember how to debit or credit things to increase or decrease them. So just as a real quick reminder here, so this is the mnemonic device. I'm going to make this look like a T account because that's kind of the idea. So what we're saying here from the credit side and the debit side is that if we're talking about a revenue or capital contributions, etc., or we're talking about liabilities, those things are going to increase with a credit, and alternatively, they're going to decrease with a debit, right? There's only increases or decreases. And remember, debit's on the left, credit's on the right. It's just left and right, right, for debit and credit. So again, if it's under the C on our little mnemonic device here, that means it increases with that side. So it increases with a credit, revenue does, liabilities do, etc. And then for the debit side, oops, let me make this match my little thing there. On the debit side, if it's an expense, it's going to increase with the debit. If it's an asset, it's going to increase with the debit. Dividends increase with debits. And then alternatively, if we want to decrease an asset, we would credit it then, right? So again, it's just kind of the opposite of what it falls under. So just a handy little tool to help you remember that. And we can use that for this exercise because that's kind of specifically what we're trying to get at here. Okay, so let's look at supplies. So supplies are something that a business owns and can use in the normal course of operations. And so that falls into the category of an asset. Again, either we could use our, we could look at assets, debits are right above that. So we know, oh yeah, it's got a normal debit balance, or another way to say that is it increases with the debit. And remember that the balance sheet, let's start with the income statement. The income statement is going to include revenues and expenses, right? Revenues minus expenses equal net income. And the balance sheet is going to include assets, liabilities, and equity accounts. And so since we've got an asset here, we'll go balance sheet. And I mean, we kind of are just going to work through these. But one other thing to keep in mind as well, just from kind of a overarching principle of accounting here and account types, etc. If we know this to be true, and then supplies is an asset, these two things, everything else about this is going to be true too. All assets will share these same characteristics. They'll all increase with the debit, decrease with the credit. They'll all be found on the balance sheet, and so on and so forth. So just keep that in mind. Okay. Unearned revenue. This is always a little bit of a tricky one when you're first learning about accounting and accounting concepts. You see the word revenue in the name, you might think, oh yeah, that's revenue, right? But if you remember back to your earlier accounting classes, the concept of unearned revenue is that we have been paid money from a customer essentially for work that we need to perform in the future. So we receive the cash, kind of think of a prepayment, from a customer for services that they're going to get in the future. So the business doing the accounting gets the cash, they get the money, but it's really not their money yet. They're just holding on to it until they provide those services in the future. So since the business has an obligation to perform some service in the future, we classify unearned revenue as a liability. Right. And so we can look over a debt circle and say, oh, okay, liabilities are under that credit side on our little T account guy here. And so that means that liabilities have a normal credit balance or they increase with a credit. And as I just mentioned, we're going to find assets, liabilities, and equity on the balance sheet. Okay, cool. So now we've got common stock. Maybe I shouldn't have spoke too soon earlier. I think I mentioned that we're only showing balance sheet income statement here. So I guess we're not talking about the statement of retained earnings, but some of these items will be found on multiple, like for retained earnings, you will see if you think back to financial accounting, that can be on either the statement of retained earnings, which I don't think I have retained earnings, I guess specifically on here, but just to throw that out there, there are more than just two primary financial statements, but we're just talking about balance sheet and income for our purposes. So with all that said, common stock. So let's take a look here. Is it an asset? Do we own common stock? It's not really falls under the category of an asset. It's not something that the business. I think of equity, and this is an equity related account. Equity as really kind of think about that accounting equation and take your assets minus liabilities. What is the residual assets left in the business if we were to subtract all liabilities? And common stock represents cash that has been put into the business, but it's the portion of that is reflected on the right side of the accounting equation, right? With liabilities plus equity equals assets. So common stock, that's an equity account. It represents ownership of the business due to the purchase of stock, essentially from stockholders or shareholders. You'll hear that term used as well. And that kind of falls in capital is another way to say equity in certain contexts, depending on what type of business we're talking about. And so we can sort of go to here. And if we want to know the normal balance of an equity account or a capital account, we can look to our dead circle and say, oh yeah, that's a credit. Cool. And again, if it's not a revenue or expense, it's going to be on the balance sheet, right? And again, like I mentioned before, assets equal liabilities plus equity. Common stock is a component of equity, so we're going to include that. That will be found on the sheet. Okay, so let's move on to service revenue. So we talked about unearned revenue before, but now we're actually just going to talk about normal revenue, basically earnings realized, in the course of business. And so here, I think that one, with that said, I mean, unearned revenue, that can be a little tricky one. So as long as you know that, but it says revenue, your mind probably went there first and you would be correct if that was the case. So here revenue's under the credit side. So it's got a credit normal balance or certain revenue increases with credit. And as I mentioned, Our income statement is revenues minus expenses equals net income. So you're going to find revenue on the income statement. And I will come back to it. We could almost fill that box in right away, but let's just revisit it to see if this kind of sticks in your mind. So now we're talking about utilities expense. And so again, is it an asset, a liability, equity, revenue, expense? Utilities expense, that's just going to be an expense. And I don't know if okay, we'll contrast that with the next item there, prepaid insurance. So utilities expenses are things that we've already incurred in the business. We've already used up all, that's what we paid for. It's gone. We don't have any future benefit with these utilities. Usually you're paying those at the end of the month when the utility company tells you how much you used, right? It's not like you're paying for utilities to be paid in the future or something like that. So just an expense under the D for our debit side. So it's got a debit normal balance or a debit increase, and we'll throw that there. Okay, and then as I mentioned before, our income statement will basically have all of our revenues minus expenses equaling net income. So we're going to find that utilities expense on our income statement. Now let's contrast that with prepaid insurance. If you recall back to your earlier accounting classes, this is a little bit where you get in revenues and expenses, a little straightforward. Then you start talking about things, like we said, unearned revenue. Prepaid insurance is a little bit tricky. And these are all concepts under the general umbrella of this accrual accounting, if you remember from earlier classes. And what we're really trying to do is not do cash basis accounting where we only account for things when money goes in or out, but we really we account for expenses and revenues, et cetera, when we recognize those or when they're actually incurred, regardless of whether you pay for it now or you end up paying for it in the future. Or in this case, with a prepaid expense or prepaid insurance, we're basically paying that up front, say maybe for a whole year of insurance, for example, and then we might pay 12 months, but in that, and so we will now record 12 months prepaid insurance asset, not expense. So we record an asset for that full year's amount. And then as the time passes over those 12 months in the year, we're going to reduce that asset, for example, by 1/12 each month and record 1/12 of expense each month. So when I explain this to students in intro or financial accounting, we kind of fill up a big bucket if we're making this payment up front, with all of the future amount of insurance that we have for, say, for a whole year. And then as we go throughout that time period, we use up that time, like we're covered for 12 months, but once that once each individual month passes, we don't have any future right to that month insurance contract anymore. And at the end of the whole thing, 12 months go by, it goes to zero. So the bucket is kind of completely emptied, but it goes down in increments. And as that asset decreases in increments, we are recording a corresponding expense at that point, so that we end up putting the expense, 1/12 of the expense that you paid up front in each month, right? So hopefully those concepts are familiar. And that will be an asset, just like with all of our other assets. Speaking and typing there, it's a debit. And being an asset, we're going to find that on the balance sheet. Okay, back to salaries expense. So I'm going to show you one little trick. If we know that expenses up here had these qualities, right, characteristics, and salaries expense is just another expense, it's not, unearned or prepaid or anything like that, then what we can do, and a little Excel trick if you're new to Excel, we can hold our mouse button, drag across all the applicable cells that have the same accurate information. Then we can copy. So I did hold Control C, or we could highlight these, right click and say copy. And then we can come down into this cell and basically paste. So I'm going to do I can do Control V. I'll show you here. So I can just go paste and just paste those answers in. And again, because we know that all expenses are going to have the same characteristics, if we know the answer above here, in the sake of being efficient and quick with our Excel and not having to type everything out, we can just copy and paste. So little Excel work as we go through this. And I should say, at any point, if you're ever confused by something I'm doing in Excel, or you have Excel questions or anything, don't hesitate to reach out. I've been using Excel as a professional accountant for almost every single day of my life for the last 15 years, both for professionally and personally. So I'm pretty good with Excel. I'm more than happy to help you work through and learn new tips and tricks and things like that. And hopefully just by watching these videos and following along, you'll be able to refine and improve your Excel skills as well. That's part of my intention with these videos and the homework assignments. Okay, let's wrap this up and get to the last asset, or it's not an asset, last account that we need to consider. So notes payable. So if you will recall back to your earlier classes, we talked about payables, accounts payable, we talk about relatively early on, and that represents expenses that we've incurred but we haven't yet paid for. So if you get a utility bill in at the end of the month, but you're going to pay that, say 2 weeks later, you're going to record the expense, right? Because we're doing accrual accounting, and you're going to increase a payable. In that instance, we would use accounts payable. So notes payable falls in a similar type of category that we call liabilities. So liability, which another way, it's money, it's things that we owe. The assets are things that we own. Liabilities are debt. You can kind of think of it as a debt, as an obligation, maybe is a better way to say that. So we have an obligation to make a payment in the future. And when we say notes payable, that's really differentiating from, say, accounts payable, which is more of like a ongoing short-term type of expense. Usually notes payable represents more of a long-term obligation. Maybe you borrowed money over a 5-year period, and then you have a note associated with that you have to make regular payments on that borrowing. Usually that's more what we're talking about with notes payable versus, like I said, accounts payable or wages payable. Wages payable, for example, would represent payroll amounts that you owe to your employees, etc. So the term payable really is just highlights that there is that obligation, there's that liability, and then different types of payables can exist. Like I said, accounts payable, notes payable, wages or salaries payable, so on and so forth. And let's just look one more time at a dead circle to lock this in. So here we are. We know it's a liability. So therefore, we know it increases or it has a normal credit balance. So we'll go and put that in. And then one last time, remember the income statement is revenues minus expenses equals net income. And the balance sheet is essentially like that accounting equation, our foundational accounting equation. Balance sheet has assets, and then it has liabilities and equity. And those two things, assets must equal liabilities plus equity, and you see that on the face of the balance sheet. So our liability will be found on the balance sheet. All right, thanks everybody. Hopefully that's helpful to start to reboot some of that accounting information that you learned previously and get us back into the accounting mindset. So thanks so much, and I will see you in the next video where we will work through Chapter 0, Homework 1, Exercise number 2. All right, thanks everybody. We'll see you there.